Welcome back. Well, we're going to be looking at Notes Receivable in this lesson. And to start off, I'd encourage you to pause the video and try and make sure that you can take the following time frames and convert them into years. For example, 3 months. Well, what will it be? We know that there's 12 months in a year, so 3 divided by 12 is 0.25. 4.5, again, 12 months in a year. 4.5 divided by 12 becomes 0.375. 18 months divided by 12 is 1.5. And when we get down to here, we've got 365 days. We must always take the units and take that into consideration. 70 days divided by 365 is 0.192. And 37 weeks, there are 52 weeks in a year, not 50 as some people believe, and that is 0.711. And you will start to realize that as you go through these questions are there to try and prepare you for what's coming up in the lesson. Here's a quick review. What is accrued revenue? When revenue is accrued, what account is usually debited? And why is an adjusting entry made for accrued revenues? Again, I encourage you to pause and review and think about what the answers are to these questions. So, now that you've had a chance to pause the video, accrued revenue, just to recap, is revenue that's been earned but not yet received. So we earned it. We did the work for it, but we haven't got the money yet. When revenue is accrued, what account is usually debited? Well, it's not going to be bank. So what is? It's accounts receivable. We expect to get that money at a later date. Again, this is recapping things that you should have learned in Unit 1. Why is an adjusting entry made for accrued revenues? Well, we're trying to follow the revenue recognition principle. We're also trying to match it to make sure that we match it according to the, that would be expenses. Forget that part. Lesson 13, we're going to Notes Receivable. And you may wonder, what's the difference between a Notes Receivable and Accounts Receivable? We'll address that question in the next slide. A written promise to pay a specific amount of money on demand or at a definite time, used to lend money for transaction or credit periods longer than normal, and to settle accounts receivable. So here's a comparison between the two. Accounts receivable, it's an informal promise to pay, and a notes receivable is a written promise to pay. So there's probably some sort of contract which has been made up, and they say what the terms are. Accounts receivable are usually 30 days or less. Notes can be due anywhere, usually from 30 days to several years. This starts to incur interest after the due date, whereas with notes, they incur interest upon the creation for the entire period. Interest is debted to an accounts receivable. With notes receivable, it's debted to an interest receivable. And again, that goes towards accrued revenues, assuming that somebody owes you money. Similarities, net realizable value is recorded on the balance sheet. They can be sold to another party, and they are similar. They require similar accounting procedures. So let's take a look. Here's going back to that whole idea of calculating interest, and we're going to have to take these times and convert them into years before we can actually calculate the interest. So up here is our interest formula. Interest is equal to the face value, that's this amount here, times the annual interest rate, which is here, and multiply by time in years. That's here, except we have to convert. I'll encourage you at this point to pause the video and try and complete these 4 spots or cells before we continue. Now that you've had a chance to complete this exercise on your own, to calculate the interest, we're going to be taking $10,000 times 5%, and then we're going to be multiplying it by 3 divided by 12 because there are 12 months in a year. That gives $125. We're going to be taking 2,500 times 3.5% times 4.5 months divided by 12 as well, and we get 32.18. You start to notice that these numbers were used in the first set of slides. $5,000 times 6.5% times 8 months divided by 12 will give us $216, and finally a face value of $3,200 at 4.5% will be, well, we're dividing by 365 days, and so we've got $14.20. Math is going to be in this course a lot, and this is what makes the grade 12 course a little bit more challenging than most, is because we have to do those calculations before we can do the journal entries. So we're going to be doing compound interest at some point, as well as just basically partial payments, how much we can attribute to each period. Note interest example. So on September 15th, FutureShop buys $6,000 worth of laptops on account from Sony. On October 1st, the accounts receivable is converted to a promissory note of 4% to be paid in 6 months. So we're going to be journalizing Sony's initial entries and adjusting entry for December 31st, assuming that the quarter ends on this date. I'd encourage you to pause at this point and think about what accounts are going to be debited, which ones are going to be credited, and the amounts. And you should spend about 5 minutes thinking about this, or less if you're quick. Let's start with the first part. This is September 15th. They buy $6,000 of laptops. This is a sale. So we generate an accounts receivable which we expect to make from it. And it's on September 15th. Accounts receivable, FutureShop $6,000, and sales credited $6,000. But what comes next? On October 1st, we convert this into a Notes Receivable account. So we have to get rid of the accounts receivable, and we convert it into a Notes Receivable. So we're going to have Notes Receivable and Accounts Receivable, $6,000 and $6,000. The complicated part comes at the very end. How much interest do we owe? Well, between September and December 31st is roughly 3 months, so we should be debiting about 3 out of 12 months interest. So we've got our face value $6,000 times 4% times 3 out of 12. So the hard part of this is getting that amount right, and you also do the calculations here so you can clearly see where the numbers came from. Again, this is referencing the previous slide. Journalize FutureShop's payment of the note on March 31st. Again, I encourage you at this point to pause and think about how you would do this. We are receiving cash at this point, so we know that we should be debiting bank, but how much? Well, we've got $6,000 plus the $60 interest which we had, but we also have a little bit more interest which we can receive because it's now 3 more months past. So we should be getting an extra $60. Let's take a look at what the entry looks like. On March 31st, we get bank debited $6,120. $6,000 goes towards writing off the notes receivable as collected. The other interest is the receivable which we've accrued over the last 3 months between December and March 31st. Sorry, January 1st and March 31st. And the interest revenue is also coming for, this is to get rid of the interest which we would have accrued in the previous time, and this here is for the interest that we would have ended up gaining from the time between January 1st and March 31st. But what if FutureShop didn't make the payment on time? How do we do that? If the note wasn't paid, here's the first situation. The note wasn't paid, but FutureShop still intends to pay. Note and interest is transferred to Accounts Receivable. Think about what that would look like here in a journal transaction. In situation 2, well, Sony believes that FutureShop is unable to pay and writes it off. And this is now testing your understanding of the previous lesson where we have uncollectibles. Again, I encourage you to pause at this point and think about what should be affected for the accounts. In the first one, we still believe that FutureShop will make good on their payments, but we're taking a note which was originally an accounts receivable converted to a note. Now we're converting it back to accounts receivable. So we're going to be debiting an accounts receivable account, and at the same time we have to credit a notes receivable. But we also have to clear off all the interest too. So we got to try and make adjustments here and there, and we've also earned some revenue from the interest as well. So here's what it looks like. Accounts receivable is going to be debited $6,120. We get rid of the notes receivable off the books, which was originally $6,000. The interest receivable, we got to clear that off the books, and we have to try and account for the interest revenue. Again, $60. But now we look at situation number 2. What happens here? We believe that future shop is unable to pay it off, so we write it off. Try and think about which account we used yesterday. What was it? Well, we have an allowance for doubtful accounts. We don't know just yet that it's gone. We won't expense it, but we do have allowance for bad debts or allowance for doubtful accounts, which comes up. In this case, we have originally $6,000 plus the $60 interest. The notes receivable, future shop, $6,000, and the other part coming from the $60. And at this point, we might think, well, we're probably not going to get that revenue from the other interest portion, so we don't even bother considering it. So that concludes our lesson on our notes receivable. Again, practice makes perfect, so you've got these recommended questions to complete on your own. If you have any questions, email me and do your best.